We are competitive. The outlook's pretty positive, but there are some challenges. There's no denying that. I mean, the strong dollar is the number one challenge right now. We used to have a challenge on the feeding side of things, meaning that we didn't have a feed cost advantage with respect to the U.S. recently. But that has turned since the start of 2011. If you look at the ratio of cattle to barley prices versus cattle to corn prices, now we do have a bit of an advantage in that regards, and margins have been climbing a little bit faster in Western Canada than they are climbing in the United States. And so we do have a bit of an advantage there. And if you look at the outlook for the next 12 to 18 months, it looks as if, looking at future prices, it looks as if this advantage is going to continue to come for, as I said, for the next 12 to 18 months. Again, I mean, because feed costs represent such an important share of production costs, then this is really important to be competitive in that regard. So this is the number one thing. And again, if you look at barley prices versus corn prices recently, there's been corn prices have been moving up a lot faster than barley prices. And we think that looking at the outlook for the next 12 to 18 months, we're likely to see the similar pattern. What could have some of the things to watch for are U.S. biofuel policy. The tax credit that ethanol blenders are getting in the U.S. is set to expire at the end of this year. But it's not because ethanol, no doubt, had a huge impact on corn prices, but I don't think it's the subsidy or the tax credit that has an impact. So basically, you're stuck with a lot of capacity in the U.S., ethanol capacity in the U.S., and it's not likely to go away overnight when the tax credit expires at the end of this year. So this is going to remain unchanged, even if you let the import tariff expire at the end of this year. The import tariff in the United States is there to prevent Brazilian firms to actually ship ethanol to the United States. Even if you let that expire and let that go to zero, given the ethanol market situation in Brazil, I don't expect any ethanol to overflow in the United States. And so really, I think the underlying factors in the market for bullish corn prices are still really present, even if we get rid of the ethanol policy in the United States, knowing that the most important instrument in the United States right now is with regards to ethanol is the consumption mandate, right? They do require a certain amount of corn or a certain amount of ethanol be blended with regular gasoline, and that's not likely to go away. So this is something that is not isn't going to change in the short future. Looking at the supply situation, we do have stock-to-use ratios, basically the number of available days of supply for corn that we have in the U.S. market, an all-time low. Similar thing in the world market. So again, supply is still pretty tight, and that's not likely to change short term. So really, we're looking at corn prices still around where they are right now, and barley prices not moving up as fast. And so again, feed cost advantages are feed cost is an important factor. Second factor is the exchange rate. I mean, it's difficult to imagine the value of our Canadian dollar going back to where it was in 05-06. So we see continued support for that because of that world growth, even though the financial markets are a little bit in a turmoil right now. Nevertheless, I think we'll see continued support for the Canadian dollar. And so we'll have to compete in that high dollar environment, really. But that's something that we've learned to do recently, and I think that challenge can be overcome in the next few years. Well, I mean, there's no doubt that really to understand the source of income growth in the world is really important to understand where our future markets will be. And really, the less advanced countries right now are growing at a much faster rate than the Western economies, the United States, Canada, Europe, Japan. And so getting market access in these growing markets would be really great because it would allow us to be more competitive in these markets. And really, that growth has a huge impact on food demand. When you see an additional dollar of income in a poor country versus in a country like Canada, the U.S., that additional dollar of income in a poor country has much more of an impact on the demand for food and beef than if that additional dollar of income would be in a rich country like Canada and the United States. So really, these countries that are going to grow at a much higher rate than Canada and the U.S., some Asian nations, obviously to China, to India, but also the smaller Asian nations, smaller in the sense that they are smaller economies, but still a very large population. Those markets are going to grow most, and currently they're the ones as well that are protected their markets most. So that for which it is most difficult to get your products to, because you're paying a high tax to get your products to. And so if we're able somehow to get market access there, this is great. If we're able to get market access in Europe, for example, although it may be just a small share of the European market, nevertheless, any market access that we can gain would be a good news for the industry. So the downside is that as you try to diversify your market, you try to move away from the United States, for example, because the United States, with their currency that is losing value on a daily basis, basically, you've seen in 2011 exports go up by, I think it is 50% in value and 25% increase in exports in terms of the volume that they have for 2011. They're really being aggressive in the world market. So as you try to diversify away from the US market, you're running into problems of high oil prices and transportation costs. So this is why it is important to have access, free market access in some of the other countries. And so working on that, I think, is a good strategy.